So I hope you can hear now. Somebody somebody scribbled on my screen. Uh, this is new. This is new in terms of what we are trying to do. Thank you all for joining in. As I had mentioned in my communication, also this is a session where we are trying to learn as much as we can. I'll try to keep it to 1 hour. I will ensure that we are not trying to cross over an hour. Just give me 1 second, please. 1 second. So all of you will be on mute. I am kind of ensuring that. Uh, I thought based on the poll that I had conducted, some of you probably would have recorded your answers in a poll. I got a lot of responses. The idea of that was to see what topics would interest you, because the idea was not to just keep on talking about what I want. So the topics which I have got in terms of a lot of responses, fixed income markets, which is where we are starting. I have got a lot of responses on I've also got a lot of response that the session should also be on derivatives. To some extent, there have been a lot of responses on equity markets, and then a lot of topics which are not necessarily connected to each other. So I intend to do few sessions before April 14th. As of now, the lockdown is till April 14th. I hope and pray that things will be fine by then, and we will probably be able to resume our normal lives by then. uh, I have a mixed audience here. There are students, there are experienced professionals, there are non-finance professionals. I have not really kept any barrier in terms of who can join. It's pretty much open to all, which essentially means that it is possible that I will not be able to satisfy all of your expectations at the same time. Some of you may find some of the things very basic. Some of you may find some of the things Greek and French. I would not be able to really standardize that part. But what I can do is I can try and answer any of your questions. Ensure that you use the Zoom chat. There's a chat box that you can see. Keep typing in your questions whenever you have any question at any point. I'll try to answer it at relevant points in time whenever I am able to see the question. The purpose of this session, as I said, is to learn. There is no charges, but one of the things which I had requested was, if possible, do donate to any good cause that you see around. If you think there is some value addition from this session, this is my very simple, uh, I don't know whether effective or not, but my way of trying to do whatever I can. And I hope all of you will also contribute. We are talking about 180 plus participants as of now. I think it will increase it. There'll be some more participants probably who will join. So even if you're talking about 100 rupees per person to a cause, we are talking about uh, more like 18,000 bucks from this session going into some charity of good cause. So let's all hope that we can do that together. Just for information, this session is getting recorded. I would be putting in the recording for further uh, receptions later. Some of you could not join probably. So I'm recording this. I hope it comes out well. I don't know how it will be effectively. Also, as I said, I'll be doing other sessions also, maybe one every 2 or 3 days. I'll keep changing the timing. 6 to 7 was the timing which I got as the highest majority, but I'll probably keep some session in the morning and so on and so forth, which obviously I'll keep communicating on LinkedIn, on WhatsApp. If you are a part of my broadcast list, then you will keep receiving the communications. Fair enough. That's about it. Let's start off. As I said, we will be talking about fixed income markets. Any questions you have anytime, just put in the chat box. Essentially, in fixed income markets, we always talk about borrowing and lending. So here we are not essentially talking about investing in a company for profits or so on and so forth. We are only talking about borrowing and lending. Now, there are borrowers in this market, there are lenders in this market, and based on the tenor of borrowing lending, it can either be a short term fixed income segment, or a long-term fixed income segment. This is critical when you see the market as an investor, as a participant, as an advisor. As I said, the list today of participation is very, very broad. So we have advisors also in this call. I can see some of the familiar names. There are investors also. There are students also. So I don't know, as I said, what to focus on, but let's see whether we can. So the short-term fixed income borrowing lending is what is up to a segment of 1 year. So anytime you see anybody borrowing for less than 1 year, which means repayment has to happen within 1 year, we're essentially talking about a short-term fixed income segment, popularly and technically known as the money market. So in the mutual fund segment also, you will see money market funds as one of the categories of funds. I will come to the practical side very soon. And then there is an entire segment where borrowing lending happens for more than 1 year. And if the transactions are happening for more than 1 year, we essentially call it the debt market. Uh, Also sometimes called as the bond market. There is no technical definitions or terms that we use every time. So money market securities are short term. You will see the transactions up to 1 year only. Now, if you look at the market, the entities who come to borrow from both the money market as well as the long term market, we can classify them into broadly multiple categories. The first category is the government of India, our own central government. They do a lot of borrowing because some of you who have learned economics would know they have something called as fiscal deficit. So our government, our country has a fiscal deficit. We spend more than what our receipts are. As a growing economy, we have a lot of kharcha spending. So because of that, we essentially are ending up borrowing every year. For the year 2020, 2021, the budget is already out in the month of February, and we are estimated to borrow roughly 8 lakh crores rupees from April this year till March next year. So that's the quantum of borrowing that Government of India does, and that's what is broadly known as government securities. So we have a big part of our bond market, which is essentially government securities, where Government of India is borrowing money from the market. The second type of borrower are state governments. So apart from the central government, we also have state governments who borrow money. So it could be Maharashtra, it could be Punjab, it could be Kerala, Tamil Nadu, Gujarat. They all have their own state level funding requirement. So they also come to issue what is called as state government securities or state development loans, which are the more popular term in the market, SDL. So you will see a lot of times portfolios having something called state development loans, SDL. That's the state government borrowing. The third borrowers are corporates. Now, when I say corporates, I can further segregate corporates into various categories because it is extremely important to know that not all corporates are of the same nature. There are multiple type of corporates we are talking about. The first are public sector undertaking, what is called as the PSUs, public sector undertakings, which means corporates who are largely owned by the government. So you will see a BPCL, you will see a Indian Oil Corporation, you will see a NTPC, you will see a NABARD, you will see a IRFC, Indian Railway Finance Corporation, you will see a NHAI. They issue a lot of fixed income securities for funding requirement. They need money, they want to borrow, so they issue bonds, they issue short term as well as long term securities. They are called as PSU bonds in the market, public sector undertaking, PSU. The second are private companies. Private companies would mean the likes of Reliance Industries Limited, Larsen and Toubro, Jet Airways, Vodafone Idea. There are a lot of private companies that need money, so they also issue fixed income securities for borrowing. The third are NBFCs. non-banking finance companies. They're a very large part of the market. Over the last almost 5 to 6 years, we are seeing a lot of issuances from non-banking finance company, the likes of Bajaj Finance, Chola Finance, L&T Finance, Edelweiss, Reliance Housing Finance, and so on and so forth, NBFCs. These are the three main categories of corporates. I will refer back to it in a while. Fourth category are banks. Banks also issue fixed income securities. We have a lot of banks, both public sector banks as well as private sector banks, who have issued fixed income securities in the past. Some of you may be aware of the fact that Yes Bank had a default very recently on one of their category of bonds. Now, corporates can borrow directly. They kind of issue securities directly, just like banks. And some of them also borrow by selling, or they basically borrow against their assets. So we have a fairly decently big type of market where they borrow against their receivable. We call them the securitized bonds. So we have certain category of bonds that are on the securitized side. I would not go into too much of advanced level initially, but let's see how much time we have eventually to discuss as much as we can. So from an investment point of view, you will see some type of securities where the issuer is paying you the money out of some of the receivable of some company. For example, there is a bond in the market, just to give you an example, where if you invest in that bond, you will get your interest, you will get your principal repayment out of the rental income of Reliance Retail Company. So Reliance Retail as a corporate has a lot of property given on rent. Their rental income is a receivable. They're going to receive all these rentals in the future. They've issued bonds against it today. So it's like against some asset you're borrowing, and whenever the rentals are received, the investors will be able to get their money back. So that is an example that you will see in the market where investors would be interested to buy these bonds. So largely we are talking about these categories in the Indian context. I'm not discussing US and UK. This is purely India. This is how the borrowers are stacked. Different amounts are borrowed, but obviously 8 lakh crores takes the cake because that's a very big amount. Government of India ends up borrowing a big part of investors' money, which in economics is known as crowding out. So a lot of analysts in India always have this thought that because government borrows so much, a lot of money is going out, and the non-government segments are not able to borrow at a lower rate because obviously a lot of government securities means that a lot of money will be taken away by them. So crowding out happens in India, which is a scenario in a developing country, nothing specific to India as such. On the other side of the spectrum in the market are obviously the investors. And I presume most of the audience in this particular webinar are on this side, because I don't think you're worrying about how to issue a bond. I think we're all more concerned about where are the investment side, who are the investors. So bigger list here, a lot of investors are there. One, commercial banks, SBI, Kotak Bank, ICICI Bank, they all invest predominantly in government bonds. They buy a lot of government bonds. Some of you would know about statutory liquidity ratio requirement, SLR. They have to purchase government bonds for that. Then we have the retirement funds. Retirement funds would include your public provident fund, your national pension scheme, your employee provident fund. Any of you who you're employed, a part of your salary is going into a PF. So a lot of that PF money is also getting invested predominantly in government bonds. So I'm not saying only, but predominantly they invest in government bonds because the idea is to keep that money as safe as possible. Then we have insurance companies, LIC, as well as non-LIC, other insurance companies. They also invest in a lot of government bonds predominantly. A big part of their portfolio is also going into government bonds. So both center as well as state, they purchase a lot of government bonds from the market. Then we have mutual funds, very relevant for a lot of us because we could be advisors, we could be investors in mutual funds. So mutual funds buy all type of fixed income securities, not only government bonds, but they also purchase non-government bonds. They buy PSUs, they buy corporates, they buy securitized bonds, they buy pretty much whatever is available in the market. Then you have alternative investment funds, not very big, but you also have them in the market. We popularly call them AIFs. They usually buy non-government bonds. They're also in the market and they don't buy a lot of government bonds in the market. But again, not a very relevant category for most of us in this particular call, in this webinar. You also have high net worth investors, HNIs as we call them. High net worth investors invest directly also in a lot of bonds as well as indirectly through mutual funds, and some of their deposits with banks also obviously go into government bonds. So directly as well as indirectly, HNIs do invest in the bond side. Then we have a lot of us who are essentially called as retail investors. Not a big ticket investor, not a lot of money that we invest, but most of the retail investors do not invest directly in the fixed income securities. You do get tax-free bonds once in a while, but other than that, most of the retail investors are investing through mutual funds. Some of them invest through national pension scheme, some of them through their employee provident funds indirectly. Again, they're not realizing it, it's not a conscious decision, but they sometimes have investments. They may invest in PPF, which also is getting invested in government bonds. So consciously, subconsciously, knowingly, unknowingly, directly, indirectly, a lot of retail has exposure to the fixed income market. They may not know it sometimes. I know of a technology friend of mine who works in an IT company. I asked him whether you have investment in bonds. He said zero. So I said, but you would have your PF money, right? He said, yes, PF money is there, but that's kind of government, right? That's a short. He's right, but the fact is that the government is also investing that money in some government securities, and to that extent, we have to understand that all these investments have something called risks in them. Risks. Nothing is risk free in this world beyond a point. So we have investment risk in fixed income securities also. Uh, Equity is risky, is obviously known. I think the last 2 months have told us how equity can be risky. People who started investing in the recent past could never believe that equity market can fall so much. But the fact is, apart from equity, fixed income securities also have risks in them. Again, some of us have seen it. We have seen portfolios probably where some bonds have defaulted recently. Yes Bank, a couple of months back, Vodafone Idea defaulted. In the past, Island FS defaulted, Jet Airways defaulted, Kingfisher defaulted. So a lot of defaults we have seen. So the next segment is to obviously understand that there are risks in these securities. But before I go into the risk side, I will just specify some of the security names that you will come across a lot. So in the money market, whenever the government of India issues a money market security, which is short term, don't forget, these are short term securities that we are talking about. You will see government of India issuing these bonds called treasury bills. T-bills. So you will see a particular type of security. These are names. I'm specifically giving them names now so that you know who is issuing what. So government of India, money market, as in short term is treasury bills. When banks issue such short term securities, we call it certificate of deposits. Those of you whose job profile involves reading a fact sheet, those of you who as investors read a mutual fund fact sheet, very relevant for you because we are talking about a lot of these investments in the fact sheet. So you will see something called CD. mentioned in fact sheet, certificate of deposit. Then you have non-banking companies, any type, any category. If it's a non-banking company, then they issue what is popularly called as commercial papers, CP. The last couple of years, a lot of uh, risk was surrounding commercial papers. A lot of NBFCs, especially, had problems repaying their commercial papers about a year back or thereabouts. So you have to understand that we are talking about short-term, less than 1 year papers issued by Government of India, banks, and commercial papers. The obvious risk when you are lending to anybody is what is called as default risk, the most obvious risk. So even if you are giving money to somebody as a friend or as a relative or in general, you know that there is a risk that the money may not be repaid. So default risk is the most obvious risk in the world of fixed income. We broadly put it in a category called credit risk. So credit risk includes default risk. Last 3 years especially, we have seen a lot of defaults happening in the market. Some names surprised us that obviously these defaults should have happened, but some names obviously were not surprising. Were surprising. There were some surprising names also. Obviously, whenever I talk about government, be it state government or be it central government, we do not assume any default risk in them. So whenever you have any portfolio consisting of government securities, be it state, be it center, you can be rest assured that there is no default risk in those particular securities. So be it mutual funds where you are only talking about government bonds, no default risk will be there. But the moment you talk about non-banking companies, there can be a serious case of default that can happen, including with some of the banks. Especially the Yes Bank saga told us that banks can also default when it comes to repayment. As far as the long term bonds are concerned, some of the names you will hear a lot are government securities. The most obvious is government securities, also called as gilt. So government securities also has this term called gilts, which are relevant. Then you will hear something called as debentures, also called as non-convertible debenture (NCD), which is non-government. So these are issued by companies like Reliance, like L&T, like any company which needs money. They can issue a long-term bond. A long-term bond is called debenture. Non-convertible debenture is the most popular term we use, NCD. Then you will also see some of these securities as asset-backed securities. I spoke about a case where Reliance was issuing bonds against their rental income. So you will see it as ABS, asset-backed securities. I already spoke about state development loans. These are all long-term. So you will see a long-term bond mentioned as debentures or NCD or gilt or ABS or SDL. When you see some of these, you know that these are long-term. Obviously, again, government means zero default risk. Government of India has never defaulted, so we don't assume they will default. Same with state development loans, but these two have credit risk. So obviously there will be credit risk when you see a portfolio consisting of corporate debentures, when you see a portfolio consisting of state development loans, and so on and so forth. These are the spectrum of assets that you will see in the market. When you invest in them, you're obviously expecting some kind of returns from them, and those returns will come along with risk together. So it's returns and risk which comes together. It is very unfortunate that in the last few years, especially till a year back, a lot of investors used to come in the fixed income space for earning higher returns. They got greedy and they thought, why not earn higher returns also? Then they realized that higher returns may come with higher risk. The returns you get in the form in from a bond will always be in two forms. One is your coupon income. As a layman, you're talking about interest income, and the other is what is called as capital gains, or it can be losses also. I will talk about that in a while. So coupon income and capital gain. From a mutual fund perspective, we have terminologies which we use in the market. This is called as accrual income. This income is called accrual. So a lot of mutual fund advisors, distributors, when they talk to investors, they use this jargon called accrual funds or accrual securities. So that means the predominant way of earning from that type of fund is only the interest income, is only the coupon income. And then there is capital gain or losses, where you are essentially talking about mark to market. Mark to market. So there is an element of what is called as MTM in this particular type of trying to earn returns. And the most important word we associate with MTM risk, or one way of earning MTM, is duration. So from again the mutual fund context, we have to understand that a lot of funds try to earn their returns through capital gains, but not every time you will make a capital gain. So you have to be very concerned about something called duration. In other words, when you are taking risk, one risk is of default, the other important risk is of interest rate risk. Something that a lot of new investors don't realize, that there is interest rate risk also, which is what is also called as duration risk. So when you see a portfolio, you have to be very, very clear that what is the reason why you're investing in that portfolio. Are you investing to earn steady coupon income, or are you also trying to earn out of some capital appreciation? You may want to earn everything together, but to understand, higher the returns you are trying to earn, more could be the risk also in that particular portfolio. These are the two most obvious risks. Other risk that will be very relevant if you are an investor is liquidity. Most of the bonds in the market are illiquid. So as an investor, you have to be very, very careful, be it HNI or be it mutual funds. When they try to sell bonds, sometimes they are not able to sell it. There's a lot of liquidity problem in the market. So liquidity risk is absolutely critical. One more risk, which again does not really come on your face, but always works behind the scene, is the reinvestment risk. So if you're a mutual fund manager, if you're a big investor in bonds, you have to be worried about reinvestment risk. Not very obvious, not on your face. You don't realize it when you see it, but it will affect your returns eventually. It may either go up or it may go down, but there is a reinvestment risk which we will see in a lot of portfolios that mutual funds are creating, or for that matter, insurance companies are creating, because insurance companies also end up taking all these risks: default, interest rate, liquidity, reinvestment. So all of these are the important risks that you have to understand. Coming to investment side, as I said, very difficult that you will be able to invest directly in the market. What you would normally end up doing is you will end up investing through some mutual funds. There are a lot of mutual funds that will allow you to invest in the fixed income category. So let me just take you to a different segment now, which is trying to understand how the mutual fund segment will work. So changing the view of what you will see now. So instead of an Excel file, I presume you will see a different screen now. This is the fact sheet of IDFC mutual fund for February 2020. So whenever you are trying to invest through a mutual fund, there are various categories that you will see in the fixed income segment. The broadly, the two categories that you have to understand is categories that take default risk or credit risk, and categories that take duration risk or interest rate risk. And different categories exist in the market for different reasons. All these classifications are given by SEBI, who's the regulator. Now, if you look at the market, you will see different categories here. The first category that you see is overnight. This category is relevant for corporates, not very relevant for retail individuals unless you need money for a 1 day horizon. If you're investing for 1 day, that's fine. Otherwise, overnight funds are where corporates put their money. All the money that overnight funds get is predominantly invested in what is called as the 1 day money market product. The 1-day money market product is called as tri-party repo, something that you will see mentioned here clearly. So IDFC is saying 99.88% of my money is invested in what is called as tri-party repo. So on any given day, if you want to figure out how much will an overnight fund give you, just go to this website, which is CCIL India. You will see something called TREP, which is the tri-party repo. You will see, so today market is closed obviously. So when the market traded yesterday, you will see that the weighted average returns on this particular category was 0.8% per annum. This is the 1-day interest rate that mutual funds will be able to earn from an overnight fund. This category is what is called as overnight fund category. So if you look at the returns of this category, you will essentially be earning very close to what is the tri-party repo rate in the market. So anybody can just check what is the rate going on. Before you invest, you will know how much are you expecting. So these days, anybody who invests in overnight funds are expecting very close to 0% rate of return. If your question is why are they investing then? Because I repeat, they are corporates. They are not sitting on hard cash. So they are investing because these days interest rate is close to zero. Not every time. We have seen interest rates higher also. We are sitting on what is called as excess liquidity segment. So these days the market is on very, very highly liquid side. So because of excess liquidity, lenders are very, very high and there's not a lot of borrowing requirements. So the interest rates are close to zero. Don't get confused with 3 days. So if you see there is something called average maturity, which means most of the portfolio is invested for 3 days. Why 3 days? Because this fact sheet is as on 28th Feb. It was a Friday. So when you invest on Friday, 1 day is Monday, Saturday, Sunday is closed. That is why you said 3 days. Otherwise, technically, it's a 1-day product, 1-day market as that we are talking about. So this is essentially what is going to be the starting point of your investment horizon. From here, you keep increasing it. So what now happens is that the maturity, the average maturity means what is the average number of days or weeks or years for which the category has invested the money in, that will keep on increasing. As you can see, you can straight away see that the duration as well as the maturity keeps on increasing. I'll come to duration part in a while, but maturity means how many days or weeks or years on an average are you going to get the money back from that portfolio. So if you see liquid fund, which is the next category, it is investing for slightly higher number of days. Now, up to 30 days in a mutual fund category, when they invest in any securities up to 30 days, there is no mark to market. They don't have to value the securities at market price. So any security that a mutual fund is holding, it could be T-bill, it could be commercial paper, it could be certificate of deposit, it could be any short-term bond. If it is for less than 30 days of maturity, meaning you will get the money back within 30 days, then you just value it at what is called as cost plus accrual. So you just keep on accruing your interest income. That is what I said, accrual funds. So you can see there is 29% commercial paper in this portfolio, 17% treasury bill, 5% certificate of deposit, and some other corporate bonds and zero coupon bonds. But if you see, majority of the portfolio is kind of very, very short term. If the paper is less than 30 days, security is less than 30 days, no mark to market. You need not do mark to market. The average maturity is 29 days. Do remember, the fund is holding some security which is more than 30 days also. Because if you're holding 15 securities and average is 29 days maturity, some of it is definitely more than 30 days. And for those securities, there is mark to market that they have to do. What is mark to market? Just value your bond at the market price. You have to do it every day when you calculate NAV, net asset value. So this is a very important uh, element in mutual fund. So liquid fund also is now doing mark to market because above 30 days horizon, we have mark to market. Then you have ultra short term, low duration, money market. What will happen is your duration will keep on increasing. This is based on SEBI's definition that the duration is basically increasing, 3 years, 4 years, so on and so forth. Now, on the left hand side, you will see there is something called as gilt fund, government security fund. You can see here also there is written as government security fund. So when you see a government security fund, default risk is zero. There is no default risk as such. But if you are talking about anything where you see credit risk or corporate bond investments or any investments which is not issued by a government, then there is default risk that you have to be concerned about. So be very, very careful about default risk. Easiest way of identifying default risk is look at the rating profile. This is called as credit rating, AAA. This is the highest credit rating that a bond gets, AAA. So government bonds are not rated as good as AAA, but you will see lower ratings also. You can see AA plus, AA, AA minus, which means the credit risk is higher. The only category where you can take a lot of credit risk, ideally, is the credit risk fund. So for every mutual fund, you will see a credit risk fund. ICICI approved credit risk fund, IDFC credit risk fund, SGFC credit risk fund. So be very careful that there could be a default that can happen. Look at the rating profile. It is mentioned in the fact sheet. You don't have to go in blind. Just check. So apart from this category, if you see in this fact sheet, everything else, this particular fund house has decided to keep it AAA. You can see AAA equivalent 100% everywhere else, but that is an exception. There are fund houses who take credit risk in ultra short duration also. They may take credit risk in liquid also. They may take credit risk in money market fund also. So you have to be very, very careful. What are you looking for in your investment portfolio? Are you okay with default risk or are you not okay with default risk? If you're okay with default risk, fine. There could be portfolios with default risk, but if you want to play safe and then you're investing in a portfolio with default risk, obviously that is something that you have to avoid. So that's why we have fact sheets. These are only bare examples. I have just picked up 3 fact sheets. There are obviously more than 35, 40 active mutual funds. Let me show you another fact sheet now. Similar classification you will see, and this is Franklin Templeton. Anybody who understands the fixed income markets in the mutual fund space knows that Franklin Templeton always, and they have been very clear about it, they do take credit risk calls in their portfolio. So if you look at their liquid fund, this is their liquid fund. If you look at their liquid fund or their ultra short, which is the next category after liquid, if you see this, if you come down, you will see there is AAA equivalent of 13%. AA of 12.75. This is the ultra short duration fund. If you look at their credit profile, AAA is 13.13, AA plus is 12.75, AA or AA minus is a very large component, which means it's a riskier portfolio as far as credit risk is concerned. So investors who are okay with that kind of risk should be comfortable with that kind of portfolio. If you look at IDFC's ultra short, just as a comparison, this is IDFC's ultra short. What is the credit rating profile? 100% in AAA. They have not taken any AA plus or AA, which is their way of managing the fund. Templeton says, I am okay with higher risk because it may come with higher returns also. So you will be able to see that your credit profile is not the same across all the funds. Because their credit risk is slightly on the lower side, you will see they are having what is called as higher portfolio yield. Yield is the expected return from that particular portfolio. It's only expected. Please don't take it as an assurance. You can see negative returns also. Don't assume that it is always going to be 9.48. But if you look at IDFC, because they are taking very, very safe portfolio, their YTM, as you can see, is only close to 6%. So one is 6%, the other is 9.5. Again, 9.5 is just the current yield. Understand there is something called reinvestment risk. So when they have a lot of their bonds maturing, when it will give their money back, they will reinvest it. They will have to purchase new bonds. and new bonds today are not necessarily available at 9.48. So you have to understand it is not what an investor will get. This is at a portfolio level. Don't see it as how much you will get. See it as an element of risk. So higher the YTM, higher the yield, definitely means there is higher credit risk or higher interest rate risk. Now, if you want to see where is interest rate risk, focus on the column called the modified duration. So some funds will call it modified duration. Some funds will mention something called Macaulay duration, Macaulay. You can see it here, Macaulay duration. So both are not same, both are very close to each other, not exactly same, but this number, Macaulay duration or modified duration, tells you how much interest rate risk you are taking. Higher the modified duration, higher, as you can see, this is higher. 2.5 is higher than a year almost. Same way, 3.36 is higher. 6.76 is further higher. It means you are taking more and more interest rate risk. If I could take you back for a second to refresh a particular important concept that some of you may know, but you should know. If market interest rates fall, like in the recent past, if you know, RBI has cut interest rates just a day back. RBI has cut interest rates. So when market interest rate falls, bond prices rise. This is called as capital gain. This is what I was talking about as mark to market component of your portfolio. On the other hand, obviously, if market interest rates rises on the other side, you will see bond prices falling, which results in capital loss. So you can have capital gain also, you can have capital loss also. How much will the capital gain or loss be is mentioned by modified duration. This is a number which is very important to measure interest rate risk. And in a very simple term, if modified duration is 3 years, the years part in that number is irrelevant. There is no concept of years that you'll be concerned about much. But if it is 3, the number, then what it essentially saying is the prices will fluctuate by 3% for every 1% change in YTM. If they're holding a bond, and obviously they're holding many bonds, that bond's prices will fluctuate by 3%, because the modified duration is 3 years, for every 1% change in YTM. So when I say change, let's assume recently RBI cut the interest rates, and suppose one particular bond's yield, the returns on that particular bond, let's say the yield fell by 0.5%, it fell. Then what it means is for 1%, the price will go up by 3. For 0.5%, the price will go up by 1.5% in this particular fund, which has a 3 years modified duration. So if the modified duration is higher, you will see higher capital gain or higher capital losses. Be very choosy about it. If you are okay with interest rate risk, that is when you will go for higher duration bonds. You have your long-term gilt funds, you have your long-term income funds. These are categories where you have higher credit risk. So when RBI has cut the interest rates, the moment they cut the interest rates, bond prices will rise. Sometimes, I mean, depending upon what bonds you're holding, long-term bonds will rise much faster than your short-term bonds. So if you go back to your fund category, you will realize that when the interest rates fell, let's say on Friday, after the interest rate was cut by RBI, this particular fund will show a higher jump in their portfolio value as compared to a fund which is, let's say, 29 days fund. Because a 29 days fund means the interest rate fluctuation will be very less. A 3.36 years means it will be that much higher. We are talking about roughly 3.3% for every 1% fall in interest rate. So if you do not know how to take a view on interest rate, duration funds are not for you. Unless you have an advisor who knows how to read the interest rate cycle, they know whether interest rates will go up or go down. And no matter who says what, it is one of the most difficult things to do in fixed income markets. Let me show you something just to give you an indication of how tricky it can get. So if somebody tells you that, oh, it is very easy to read interest rate cycle, this is what is called as the 10-year interest rate or the 10-year yield. This is the 10-year yield starting last October till today. It has fluctuated all over the place. So when yield goes up, when you see this scenario where yield is going up, you will see NAV falling. Over a period of time, if you see this chart over a period of time, over the last, let's say 3-4 months, yield has definitely come down. As a result, the prices of these bonds will go up. What is this bond? This is the 10-year bond. Any portfolio having this 10-year bond, the prices would have gone up for that particular portfolio over the last 3 to 4 months. So to risk, you have to be very careful about when you see a portfolio. And the moment you see that portfolio, please be very careful whether are we talking about interest rate risk or you're talking about a duration risk. Do you want to take both? Do you want to take one? Do you want to take zero risk on the interest rate side? The choice is totally of the investor. The second important thing you have to always be careful about is even within AAA names, even within AAA, so it says AAA, PSU bonds have lesser chance of default as compared to private sector bonds. So you might have an Island FS, which is AAA. You will also have a NABARD, let's say, which is AAA. The chances that Island FS will default is larger. So even though you have seen AAA here, it is very, very useful to go further and check the actual portfolios also. So this is the fact sheet, as I said. It's always good if you go further, deeper, and be able to find some of these portfolios. So this is the IDFC Ultra Short Term Fund. We already saw it is all AAA. You can see AAA, 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 AAA everywhere, right? Also, look at the names. Also, always take a look at the names. Look at what is the name: Reliance Industries, NABARD, L&T, Bajaj Finance, Power Finance's PSU, IRFC's PSU, NHB's PSU, SIDBI's PSU, Kotak Mahindra. So look at the names. As an investor who understands market or as an advisor, the names will tell you a lot whether it has default risk, which is very predominant or not. Let me show you Templeton, which always takes that extra default risk. This is not a question of what is good, what is bad. This is a question of whether you are aware of the risk you are taking. So if you look at this portfolio, first of all, what you will realize is this is also ultra short term, same category. But what you will realize is the number of bonds are much higher here. Look at the total number of bonds and look at the names also in that bond. Suddenly, no matter who you are, not many would know about what is Clicks Capital Services or some of these names. So you have to be very clear. Are you comfortable with the credit risk or are you not comfortable with the credit risk? If you invest in Franklin Ultra Short, saying that, oh, Ultra Short means less risk, and then when the NAV of that fund falls because of a default, please don't blame the fund manager. When in January, this particular fund had a Vodafone default, lot of advisors and investors were like, oh, this is not fair. They were always clear that I take credit risk. You cannot read it. It is your problem. If you can't see that there is a single A minus paper here, if you can't see there is a double A minus paper here, if you can't see there is a single A here, well, you can't blame the fund manager. He is he's disclosing what is he holding. So you have to choose what category are you interested in. And obviously, these risks will manifest in the performance also. Let me just show you the fact that their performance have not been same. This is the last 1 year, roughly. The last 1 year, if you can see this fluctuation or performance, as we call it, of some funds. Now, what are these some funds? The blue line that you see, this blue line, is the Franklin in India Ultra Short, the portfolio which I just showed you. Always above the category, always above this is the category, this is the average, this gray line. Always above competition, every other line you see is below. But when it takes risk, the chance is the Vodafone default part. Sorry, I'm not sure whether you can see the chart or not. I hope you can see this chart, which is visible here. I hope that's. Oops, my setting is all messed up. Sorry, give me a second. Yeah, if you see this blue line, this is the last 1 year or so horizon. It always went above everybody else. You can see the performance, absolutely brilliant till a default happens. So be very careful. This is the Vodafone Idea default in January. When a default happens, as per the latest rules of SEBI, you have to put it in what is called as a segregated portfolio. You keep that particular bond separate, segregated. You can see it suddenly went below pretty much everybody. But then again, because it has higher credit risk, you have extra higher returns also later on. The black one, if you're wondering, the black line, suddenly you can see right from last year, you saw one major default here, and then it had a small problem here. Then it went up, again a problem here. This is the UTI Ultra Short Credit, UTI. Unfortunately, they've had a lot of defaults in their portfolio. If you see this red line, this red, which is the second after this blue line, that's ICICI approved Ultra Short. So that is like neither as safe as IDFC nor as risky as Franklin. You see the pink line. The pink line that you see is the IDFC one, the IDFC short term, which I showed you as a AAA portfolio. Now, a couple of important things here that you have to understand. In the recent past, what happened was that I will discuss in a separate session, which is the live market session or a recent happening session. The interest rates recently, if you realize, actually had just jumped few days back due to some liquidity pressure, due to some flight to liquidity, as we call it. So a lot of bonds in the 1 year, 2 year, 3 year space, or even 6 months, 3 months, their prices crashed. You will see this dip in all the funds. You will see the dip in all the funds. That is interest rate risk part. That's not because of default. Default will always be a line like this because suddenly a part of your portfolio is gone. This is interest rate risk. The yields went up, the prices crashed. So this is something which basically happened few days back before the repo rate cut happened. When the repo rate cut happened just on Friday, because the interest rates went down, the prices went up. The latest NAV, if you see, all of them have gone up. All of their NAV has gone up. Returns have gone up because interest rates on Friday has fallen. But Thursday, Wednesday, Tuesday, if you look at those days, there were scenarios where the prices were falling. Even for PSU bonds, the yields went up. Also, after March 15th, a lot of corporates redeemed a lot of money for advance tax outflow. So some of the liquid funds also witnessed a lot of redemptions. Let me just show you. This is the recent redemptions we have witnessed in the liquid funds. So what happens is when suddenly the fund manager is facing liquidity outflow, which means redemptions are happening. This is some of the bigger liquid funds. Automatically, what essentially happens is that the bonds are sold in the market, and because there is no demand due to lockdown, the prices have crashed. You can see the NAV drop of some of these liquid funds between March 16th and March 24th. They gave negative returns during that time frame. This is all negative. Usually liquid funds will not give negative. That's because a lot of outflow happened during this time frame. I have collated this data from Amphi. It's not easily available. You have to work around a lot of numbers. Just for those who are wondering, where did I get the 24th AUM from? Because fact sheet is obviously not available. So you have to understand that liquidity is a concern and all that will affect in your returns. This is your returns of various categories. You can see overnight and short duration funds returns off late. Last 1 week, last 1 month has been very bad because of interest rate risk in some of the portfolios. In some cases, a default or two has happened, but that was more of a month or so ago. I am getting few questions in the chat box. I will just answer it in a while. I'm just wanting to wind up some of these points, and then I promise to take up those questions or pointers also. This is performances that you see of various categories. In the last 6 months, I showed you a 10-year yield chart which had fallen. So if you see a long duration which takes interest rate risk, look at the 1 year returns the fund has generated 16% per annum in the last 1 year. That is because of interest rate risk. So if next 1 year, let's let's think that interest rates are going to go up. If it happens, the same category may show you negative returns also, because they are kind of taking interest rate risk. So you have to be very careful if you are looking at the market. What is the risk you are comfortable with in the market? If you are not comfortable with a whole lot of this risk, then please do not take it, is what you will realize. So the screen has been stopped, sorry, for a while. Don't get confused. So just to summarize what I was saying, when you're investing into the fixed income world, most of us will not be able to purchase the securities directly. Just be careful what is the purpose of your investment. There are investors who basically say that, you know what, let me invest for safety. Let me ensure that only capital preservation is what I'm expecting. So you can go for very safe AAA PSU type of portfolios, where the returns obviously will be slightly lower as well. But then please choose what you want. You can't say, I want the highest possible returns at the smallest possible risk. That is something which is close to fantasy. That is something which you may not be able to see every single time. If you're okay with the higher risk, like I know of a lot of investors who are comfortable with Franklin Templeton, obviously it means that they know that once in a while there will be a tough time in the game. But if you look at their long-term performance of 1 year, 3 years, they have beaten the competition because of the extra credit risk. So the point is that, not everybody will default. Even if somebody defaults, I have so many securities in my portfolio that I'm diversifying my credit risk. Interest rate risk more difficult to take for an investor. You as an investor will not be able to easily look at the interest rate. So either you have a good advisor who knows it, or you can basically look at what is called as a dynamic bond fund category, slightly advanced level of bond fund category, where the fund manager uses his or her skills to try and earn from capital gain. So this is skill based. So the fund manager has to be very good. We have had scenarios where fund managers have done very well and earned 15-20% consistently. And because it is skill based, it will have a higher cost also. You will have to end up paying higher expense ratio for a dynamic bond fund, also sometimes known as all seasons bond fund by some of the fund houses. This is where they take a lot of duration risk, and some of them also take credit risk in this fund. If you want to purely take credit risk, we have something called credit risk funds, or you can pick most of the UTI or Templeton. They take credit risk funds in most of the cases. You can go to a very beautiful website called Value Research online for getting all information. The expense ratios, the cost, everything will be mentioned in that particular information. Obviously, if you look at some of the short-term debt funds, you will see expense ratio in the range of 0.3, 0.4, 0.5%. Long-term duration fund, a dynamic bond fund, will be in the range of 1% or so. So you think whether you will be able to earn that extra half to 1% through the fund manager skill. And do remember, fund managers are human beings. They are not God that every time they will get the interest rate cycle right. You will be very careful about that. We have specific questions that I would try to answer. I don't know whether there are questions or some of them are just information. Only Templeton takes higher credit risk. I just took an example of Templeton because they are known in the industry to be on the higher credit risk side. But there are others. There is UTI. There is a couple of other fund houses that are very visibly taking extra credit risk. So as an investor, you should know that. A lot of economists are claiming we are entering recession. How should one plan their tax-saving investments in fixed income securities? Uh, what are the tax planning instruments you have in fixed income? You have your PPF. I think that's about it. No other mutual fund category in fixed income will give you tax saving. PPF is a long-term game where you get tax benefit. 8% is obviously very high. Slowly, gradually, returns will go down. There also, you will get something close to 7.5 and 7 eventually. Side pocketing, yes, side pocketing is what is the segregated portfolio logic. If repo is cut down, that would mean more money would be available in the market, which in turn would mean higher demand, which will push up prices. If prices are going to be higher in the future, people would require more money to buy the same unit of any commodity. Why the bond prices will go up if repo rate cut happens? Because from a pure valuation point of view, lower the interest rate that you are using for valuing a bond, and if the bond's coupon is slightly higher, then the bond has a higher valuation premium that they will get. So the only important thing is the bond that you're holding in the portfolio should be having a higher coupon as compared to what the future interest rate is going to look like. So if you're currently holding a 6% bond, and if interest rates are cut to 4% eventually, you will see that 6% bond will become attractive. So there will be a mark to market gain that you will be able to get in that particular portfolio. How much will it go up by depends upon the duration, obviously. How to follow bond market for retail investors? As I said, there is a website called cclindia.com. Let me show you that website. Obviously, today market is closed, so I will not be able to show you. So this is the CCL India website. Here you will be able to see the prep, which is the overnight rate. This is the money market rates you will see. You will see how much is it trading. On the left hand side, you will see RBI NDS OM. If you want to know all the government security yield, you will be able to see it here on a live day. So tomorrow, if you log in, go to this, you will be able to see all the government security prices also. There are information available in abundance. I will be taking a separate session for that, which will be more connected to live market. Here, the idea was to just introduce fixed income because some of us are new to it. Yes, you should definitely diversify across mutual funds. One of the fixed income investors I really appreciate a lot and look up to. He has a very simple idea. 60-70% of your fixed income portfolio must be in your core bucket. Core bucket is your short term debt, your income funds without too much credit risk and all. In the remaining 30%, you can take credit risk, you can take interest rate risk by allocating certain percentages to a dynamic bond fund, to a credit risk fund, so that you don't have high exposure to a particular category as such. FDs versus liquid fund. Liquid fund gives you better post-tax returns on a 3-year horizon. So liquid funds generally give you better returns than FD, not in the last 3 months, obviously, but in general. Plus taxation benefit obviously helps. I'm not covering taxation in this session. There will be a separate session for that. Is there any other question that I think I want to answer at this point? Can we expect more interest rate cut from RBI? I definitely think so. If there will be a lot of coronavirus cases coming up and economic data falling. I will talk about duration in a advanced session. This is the basic session. We have to obviously come into an advanced session later. Yield spreads are higher currently. Yes, it is because the bonds have been sold in the recent past. Some of the corporate bonds are trading at a higher yield. So you can take advantage of that if you are a savvy investor. Any specific reason behind valuing? SEBI has a rule up to 30 days, no mark to market. So if you are a liquid fund holding less than 30 days paper, then there is no mark to market that you are going to see. For everything else, there will be a mark-to-market component. Liquid funds invest mostly in less than 30-day securities. So obviously, to that extent, there will be a mark-to-market. There will be no mark-to-market risk that you're talking about. What is your long-term view on the current market situation? Long-term view on the current market situation. So current market situation is short-term. At some point, I'm assuming it will ease off. We will come out of the coronavirus is what I'm hoping. If not, then the long-term doesn't matter anyways. There will be short-term issues with the bond funds. You will not be able to see a lot of returns for the next 1 year. My sense is if you're investing in bond funds going forward, expect just about 5% returns, not more than that. Don't expect too much beyond that. In case of default, will there be no capital gain? Capital gain is on your buying NAV and selling NAV. It has nothing to do with what is portfolio's performance. You have to see your purchase price and your selling price. If your selling price is lower than your purchase price, there is no capital gain. What is your preferred category of debt fund for now? I am looking at medium term debt fund. There is some interesting value proposition available there. If you pick a 3 to 4 years bucket of good AAA rated portfolio, hold on for 6 months. I think you will be able to get 5 to 6% per annum. As I said, not more than that. Segregated portfolios, how it works is it just kept separately. No NAV calculation happens. Whenever the money is available, whenever the issuer gives the money back, you will have to give that money back to the original investors as on the date when you segregate it. It does not impact the basic portfolio's NAV. So once you have reduced the NAV, you saw a drop in the Templeton case. After that, the remaining portfolio will be affecting the NAV, nowhere else. The segregated portfolio doesn't affect the NAV after the first day. Which are the best liquid funds? Nothing much to choose. Look for one where credit quality is very good. Don't take credit risk in liquid fund. Also look for low expense ratio. Liquid fund should be on the lowest expense ratio side. Just look for less credit risk and less expense ratio for liquid funds. Yes, if you redeem from the basic fund, Adinath, you will still have a claim to segregated if the eventual money is given back and you are holding the portfolio on the date of default. They will identify you and give you a part of the money back. I had promised it to be a 1 hour session. Some of you obviously may have commitments. I also just want to request one final thing. I had said this in my invite also. If you had any value addition, ensure that you are contributing to any of these relief funds or anything else. There are animal shelters also. The cat you see is one of my cats, Muffin. I have 5 cats, and this is how Muffin looks at me when he is hungry for food. So I'm sitting on a bed and he's just staring at me and saying, "Give me food." And he's well taken care of at my house, but there are a lot of strays outside where they are not taken care of. So if you really can donate something for strays, be amazing. So thank you so much for your time. I'll have more sessions like these. Give me feedback on WhatsApp. This is my contact details. Ensure that you share feedback. This was a basic session. We will have more advanced session going forward. Have a wonderful lockdown time. Enjoy. Bye-bye.